As there are many different chart indicators, we will take a look at 4 of the more commonly used ones: MACD, Stochastic, RSI, and Parabolic SAR. These are also known as oscillators. MACD stands for Moving Average Convergence Divergence and is used to indicate a potential bullish or bearish trend reversal. The indicator consists of 2 lines representing a fast and slow average, along with a momentum histogram, represented by bars in the middle of the indicator window. Most charting packages use a default setting of 12 periods for the fast-moving average, 26 periods for the slow-moving average, and 9 for the histogram. When the moving averages get further apart, the histogram gets bigger, representing divergence between price and momentum. When the moving averages get closer together, the histogram gets smaller, representing convergence between price and momentum. When the MACD indicator shows a crossover of the moving averages and the histogram becomes smaller and eventually appears on the opposite side of the neutral level, this represents a reversal in the trend. Stochastic indicators are also used to determine potential trend reversals. They show a percentage scale on the x-axis with 2 horizontal lines at, for example, 80% and 20%. This can be changed depending on your personal preference. When stochastic lines are above this 80% level, it indicates an overbought market condition. An overbought market condition is when an asset rises in value very quickly due to a surge in demand, pushing the price to a level above what the fundamentals would appear to support. When stochastic lines are below 20%, it indicates an oversold market condition. An oversold market condition is when an asset drops in value very quickly due to a wave of selling, pushing the price below what the fundamentals would appear to support. Stochastic indicators are normally used as a secondary indicator to an MACD. The main objective for a stochastic is to indicate that the market is moving to the end of its current trend and is potentially looking at a fundamental change in direction. RSI stands for Relative Strength Index and is very similar to a stochastic indicator because it also identifies overbought and oversold market conditions. The default setup in most charting packages is 14, which means that it's based on a 14-period moving average. An RSI indicator is represented by a single line, which is graded from 0 to 100. Anything below, for example 20, indicates an oversold market condition, and anything above 80 indicates an overbought market condition. RSIs are often used as trend confirmation indicators. Their neutral level is 50. If the RSI is above 50, it is indicating an uptrend. If it is below 50, it is indicating a downtrend. A Parabolic SAR stands for stop and reversal and is used to identify trend endings and potential reversals. A Parabolic SAR consists of dots on a chart, which indicate reversals in price action. If the dots appear below the price action, it indicates an uptrend. If the dots appear above the price action, it indicates a downtrend. These 4 popular technical chart indicators are primarily used to identify a change in the prevailing trend. As these indicators are displayed underneath the price action, they offer a clear way to spot important changes in the market.